I'm Ashton Addison from BlockWest Capital for Investment Pitch Media, and today on the Crypto Coin Show we have Gareth Ward, co-founder and COO of Bumper, back once again with us. Gareth, it's a pleasure to see you again.
Yeah, you too, Ashton. Thanks for having me again.
You're very welcome. We followed up with Bumper a few times over the past years, working on your DeFi 3.0 Bumper protocol that we're going to dive into today. But for those who haven't seen our previous interviews or they aren't familiar with Bumper, I would love to start off from a high level on what is the Bumper protocol that you and your team have built and how does it relate to decentralized finance?
Yeah, so Bumper is a permissionless, non-custodial, decentralized protocol which offers price protection for kind of effectively, potentially any unstable asset. So, for example, ETH. Now we're going to be working on the main kind of top-level assets like ETH, WBTC, and stuff like that. But what essentially the easiest way to understand it is if you had $1,000 worth of ETH and you wanted to protect that, let's say 95% of it, you send that to the protocol. Now you create that floor for a period of time, and if the price dips low enough that actually the value of that ETH is now worth less than the $950 you protected at, and you make a claim, you come out with $950 worth. So essentially, you've now protected that asset. You paid a premium for that. If for some reason it doesn't, it pops back up during that time, and there's no need to claim. You're still in that asset. So for those who have a kind of long mentality on a particular asset that they like ETH, then you're not going to be lose out like stop losses and things like that. And this is far more efficient than other hedging strategies like options and stuff. So.
Okay, very interesting. And I want to dive into that sort of stop loss and other DEX options versus Bumper in a little bit here. But I'm curious on what sort of inspired the need for Bumper, because this is a whole unique kind of financial solution for decentralized exchanges.
Yeah, so about 3 years ago, Jonathan and myself were working on a project that really got hampered a lot by regulation, and we saw what was happening in DeFi. It was kind of that DeFi summer, and it just exploded. We felt there's the returns and opportunities and just the nature of DeFi. I kind of felt it was almost back to why you enter crypto in the first place. We've gone down this path of a very kind of centralized systems, custodians, and centralized exchanges, all that. And it was kind of almost coming back to the roots of crypto, and that was very appealing. What really happened was that we looked at the DeFi market and said, where is there a kind of issue, a niche problem that we could potentially solve? And what we saw was CDPs and over-collateralization in lending and that kind of thing. But how can we bring that down to kind of not have those kind of high levels of collateralization? That was the initial idea, and what stemmed from that was really, okay, well, could you swap in and out of a position? And what we found very quickly in back testing was that, once you do that more than kind of once a day, it becomes pretty prohibitive, and you get caught in what's called a whipsaw scenario of trading in and out, and you just lose too much of the underlying through that kind of slippage. So what we realized is actually what we're solving for is slippage. And at that point, we engaged with a development house to help scope the idea further. We had ideas on how to utilize pooling, which was really the key to DeFi, and to kind of aggregate the players in the market. And at that point, Sam Brooks, who is our CTO, was CTO of that dev house, and basically he helped take it to the next stage of development, and Bumper really kind of evolved at that point. And we realized that if you can do things in the aggregate with those pools, then you can create a much more efficient marketplace for risk. That's what we've done.
Wow. Very interesting, starting back all the way when DeFi summer was starting, and decentralized exchanges and DeFi have grown quite a bit since in the past 3 years, but I feel like there's still a lot to be done. And I'm sure you know very well, working on an application as intricate as this in a part of the industry as innovative as DeFi, it's not something that can be built overnight. And you and your team have been working on this. We've spoken over the past few years as different iterations have come up. And then now I see that today, finally, there is the public launch of the application. So first of all, congratulations on that. I'd love to hear a little bit of that story, and then leading up to the launch and what it means to finally launch to that greater public.
Yeah. I'm not going to lie, it has been a tough journey, from outset. We raised well. It was a good time in the market to raise funds. And it's just been challenging, very, very challenging. What we're trying to do is something very different approach to how to kind of hedge that risk. There are numerous protocols that have kind of taken options and just kind of put it into the decentralized kind of systems. But essentially it's the same way, it's the same kind of pricing, the same kind of offering to the public, to the users that you would have in traditional finance. So we tried to take a different approach, and when you're trying to create something very new, there's just so many vectors that you have to kind of think about. DeFi, by its very nature, is a very hostile environment for hack risks and also, market understanding. It's hard to know who your users are because all you really have is a wallet and no real understanding of their demographic. And I mean, there are some applications that are coming around now that are starting to try to extract information in no sense, but it's still pretty nascent. So what you're doing is we created a protocol with, as best understanding as we could of the marketplace, but also the challenges of how to build something very new that is actually very complicated under the hood. Thankfully for the user, it's really just a matter of a few clicks to get you into a protected position or to, provide yields on the other side of the pool. But fundamentally, it's actually extremely complicated. And what we've also considered were some of the issues that some of those kind of decentralized options platforms had. We were thinking about those early and how to mitigate that. So it has just taken a long time, but we're here. And,
it's a long time coming, but I feel like it's also a great time to be launching because although Bitcoin has sort of been sideways for most of 2023, I feel like Bumper would do especially well in where not everybody's just expecting the price to go just up, because if they're trying to protect their assets, it's these years of these middle years between the bull market where this would come the most handy.
Yeah, and what data we could get and kind of glean is that there are those periods of where the asset's a bit twitchy and you're not quite sure which way it goes. When there's a definite move up, then people feel very buoyant. But like you said, it has been sideways for a long time, but it's been a little bit twitchy because the macro global market has not fundamentally changed. So just don't know how real this is. With the recent dump as well, that kind of emphasized that fact. The reality is that when the market starts to feel quite at the top end, people do tend to take out options and things like that, start to hedge that risk. So it's definitely something that there are a few very key areas during a market cycle that hedging risk strategies become at the forefront of people's minds.
Mm-hmm. And I want to fill this story in a little bit more, because you mentioned there in your previous answer about how there's two sides to the coin. There's those that are protecting their assets, but there's also those that are earning from depositing stable coins. It's beautiful that people are able to sort of choose, what kind of yield they want to get, or where they want to protect their assets from different parts of the protocol. And these decentralized nature, sort of like someone's helping on the other side fill in the people that want to protect their assets. Can you explain that a little bit further on the different options that people have to participate into Bumper?
Yeah, absolutely. So it's fairly simple. There's if you can imagine just two sides, two pools. That one side is the taker side and one side is the maker side. So the takers are the ones that are taking out the protection on their ETH asset, for example, an unstable asset like ETH, and they're trying to protect the value of that. The other side of the market is provided in USDC by liquidity providers we call makers, and those makers basically buy that risk, essentially. So the way they are rewarded is that they earn those premiums that the actual takers are paying for that policy. So that's what I like to call a direct and true yield. Mm-hmm. It's not some kind of funny DeFi farming, some obscure token. You're getting yields directly from the takers. And as part of that, you're taking on any risk, but you're doing that in the aggregate. So as a pooled consideration, you will have risk tiers that you can kind of maximize your yields and take on more risk, or on the other side, you take on less risk and lower that yield level down. What we're finding and what we've done is we've had to build a really extensive simulation. So we've kind of been doing two levels of very serious development over the last couple of years. One is the actual protocol and the smart contracts that go with that. The second is the simulation to help us understand and essentially take the technical specifications of the project and build that into a kind of Python code, run those simulations, agent-based modeling, millions of passes on that to understand with upwards of the last 4 years of ETH pricing to essentially set the parameters and whatnot. And what we've done is also compare that to something like Deribit, which is the biggest player in the options market. They're obviously centralized and more efficient on price than other decentralized options out there. But we are finding that we are on average 30% cheaper on the premiums, and yet we are also on average 10% yields. So what that does is, back to what I said earlier, we've created a very highly efficient marketplace for risk. So both sides are maximizing, and it works out not as costly as kind of traditional options that are out there.
Very interesting. And I feel like all this testing and AI may have something to say about, what's the perfect yield on both sides. From what I understand, if, say, for example, Ethereum is at a new all-time high and then it looks like it's teetering off the edge of a cliff, there's a lot of people that want to try to protect their ETH on the downside through Bumper at the same time. Then if there's a huge influx on one side of the pool, that will affect the premium cost or the yield rates that people are getting for providing on the other side?
Yeah, I mean, back to AI, we definitely want to work to engaging We use some AI in code, but we definitely want to kind of integrate it into not only the simulations, but kind of taking the real feeds and seeing what we can kind of optimize even further. Yes, that kind of scenario is likely, that people will, at that kind of where they feel the market is starting to top out, start to consider hedging risk, kind of risk strategies. And Bumper will certainly be up there with the options out there in the market. What happens is when volatility is high, there are a whole bunch of parameters that essentially define a premium. And that could be your own considerations. So what floor level you set it at, 95% versus a 70% floor level will make a higher risk. What the status of the protocol is, where it is in relation to the pools on the taker side and the pools on the maker side will have an influence. There'll be things like the volatility in the market on that asset will also play a role. So you'll have although that might create a higher premium at that point in time, what you are doing is you're basically getting the best premium you can at that point in time compared to anything else. And then if volatility goes down, 20 days later, you'll be paying a much lower price because the considerations, and you pay that as you go. So it's more dynamic, and that helps to create that kind of efficiency. The benefit in that highly volatile situation is that a maker comes in, because those premiums might be high, those yields are going to be higher. So that's going to be very attractive for them. And what we can't forget is that fundamentally takers and makers are aligned in their viewpoint on that asset. So a taker believes in ETH, for example. That's why they want to protect it. They don't want to go out of ETH because they want to be in ETH when it pumps. But they want to protect that value at the times where there are those dips. The maker, on the other hand, is providing USDC, a stable coin, to provide that kind of support to the protocol, but fundamentally is also positive on ETH because they just have different time frames. So they might have a longer time frame on ETH or a shorter time frame on ETH compared to takers. So it's what's beautiful about the protocol is that we find very quickly alignment between the players in the protocol.
That's very cool, Gareth. And you mentioned at the very beginning about comparing this to sort of like a stop loss as some kind of option for decentralized exchanges, but different or better in a way. I want to jump back into that because currently, on centralized trading, there almost has to be these options of stop losses, limit losses, things like that. But DEXs don't all have that yet. They're still sort of in their primitive stage. And I feel like that's why this could be a good opportunity for Bumper in a decentralized way to have other functionality for people that are trading on DEXs. I do know there are some DEXs or other Telegram bots and things like that that are coming out with this extra functionality, whether it's stop losses, options, or hedging. But I don't think it's exactly like this. Is there a cost benefit of Bumper's protocol as like a comparison?
Yeah. So you're right. There are kind of stop losses you can do in decentralized fashion, but they haven't really evolved in the 3 years since we started. So there must be something about them that's not quite working for the market. Stop loss is a really good example of differentiating. So there's no way that this complicated protocol would fundamentally just be a stop loss, right? So whereas a stop loss, you set that stop, the price goes down, it goes below that stop, it's triggered, and it sells out. You're now out of that asset. That can be a very temporary moment in time that it dropped 1 cent below, you stopped out, and we've all been there, and then kicked ourselves that we set that stop loss at that point, and then it just pumps and goes double price. And you've been holding it for like a year, waiting for that, and you decide to protect, and you ended up on the negative side of that transaction. And we know good traders know where those stop losses are, and they kind of chase them, and a lot of people lose out. So Bumper is very different and far more complicated to build, to manage that. And what it's doing is you're not going to find yourself in that position. So it will drop below that kind of point that you would normally have set a stop at, and you'll just maintain the value that you've set it at. And then if it pumps back up, you're still in that asset. So you've protected from the downside, but you've gained from the upside, and that's the key there. Options strategies are essentially, you take out an option contract. What you're doing is you're paying a fee to potentially sell or buy that asset at a different point in time, at a different strike price. They're fairly rigid in their approach, and the most important aspect is that actually they're not that cost effective. Because it's kind of a peer-to-peer, they're not using the aggregate like we are. They tend to be fairly inefficient on price. They are quite complex and confusing for a lot of people. So I looked at someone on Twitter recently trying to explain options and whatnot, and said, I'm going to simplify it for you. And it took like 11 or 12, in the stream to kind of explain it. And, it's been the system to use for the last 50 years. And they work on a Black-Scholes pricing. But there is a premium that you pay on that. And Bumper, through the design of it, has stripped back those kind of loaded pricing points and created a more efficient kind of protocol.
Yeah, and I think simplicity is going to be key for adoption, especially when you're bringing in traditional traders and investors into Web3. There's already a barrier to entry moving into different kinds of assets and new kinds of wallets on top of that. And trust me, I know the complexity of options. I've taken the university courses in pricing options through Black-Scholes model by hand, and it's not just a 12-post Twitter thread. It's months and months of mastering. So I appreciate breaking this all down, making it easier, especially for people that are just starting to trade inside of cryptocurrency.
Yeah, absolutely. And, that's in part what we've done is we've actually used our own pricing model. And in simulations, what we found, and we weren't expecting this at the time, was that it tracked Black-Scholes very well. It was, even though it came from different inputs and formulas, it tracked it quite well. So what that kind of did was validate that our understanding and approach to risk and pricing risk was in line. But where we found that it was cheaper and is that by using the aggregate, using pooling, the very essence of DeFi, we were able to make it far more efficient and serve the market as the market requires at that point in time. So it's absolutely a very unique protocol. We're pretty proud of it.
Very interesting, Gareth. And I want to jump back to the fact that today is the launch day, because this is probably going to change a lot of the operations for you and your team now, like supporting customers, making sure everything goes smoothly as the product launches. Can you talk about if there are any incentives or how people can start using it on day one, and if it's beneficial to start earlier?
Yeah, absolutely. So we do have an incentive program. So there will be, for anyone using the protocol, whether you come in as a maker or a taker, you'll get a percentage according to your deposit amount in bump tokens. And so that it works on a curve. And so the earlier you get in, the higher that percentage will be, and that will reduce over time. So for anyone, if you're kind of interested in using Bumper or you're planning to use it, best to jump in as soon as possible to capture those incentives. What we've also done is that if you, by the very nature, the longer the term you put in, the more deposit you put in as well, then you'll capture more of those bump tokens on offer as part of that incentive. We do have a support infrastructure in place. So if there are any problems, there is a Discord channel. Community moderators will facilitate that. We have an email, so support@bumper.fi, for anyone who has a query, and there is lots of documentation as well, and kind of step-by-step guides and whatnot to help you through the process. But to be honest, the app is quite simple, and for those that feel comfortable in connecting a MetaMask wallet and have worked, who have operated DeFi, it's going to be a no-brainer for them.
Very cool. And you mentioned there about the Bump tokens. I recently saw that Bump is trading on some dexes, and there was a listing on Bitmart as well, which is very cool. I'm curious if you can touch on how exactly the benefits of using Bump within the protocol. I'm guessing it has something to do with the premiums or the fees or staking. Maybe you can just touch on how that makes a sustainable ecosystem.
Yeah, so the Bump token's an important one, and we've tried to take an approach with the token that the value, everything that we can do to drive value to the token is guided by the concept that a user must provide something to the protocol. You support the protocol in some way, you'll be rewarded. And so what that does is it integrates a supportive user base for the protocol with the actual token itself. So the first thing is, when you take out a policy, you bond Bump tokens to the protocol as part of a policy. You get that back at the end of the policy, whether you close, claim, or whatever. You'll get that back, but you kind of bond it to the protocol on entry. That's the first point. The token is a governance token as well, so you can put it towards voting and have a say in the proposals that are put forward and the future of the protocol. The other aspect is that, and we don't have this at this point, but there will be a staking module that will be available, and what that will act as is a kind of ultimate backstop in the protocol. A bit like the Aave safety module works. Now that's kind of for slightly different reasons, but fundamentally people stake their token and take on some risk, but for that they are rewarded with kind of incentives. So again, it comes back to that philosophy of do something for the protocol and get rewarded in those tokens. We now align everyone with the token and the protocol, and it becomes quite integral. So it becomes kind of the grease in the engine, the oil in the engine of the Bumper protocol.
Amazing. Well, thank you for explaining that, Gareth. And I'm looking forward to seeing how Bumper grows, and especially with the market that we're seeing right now. Just this past week, Bitcoin actually made the biggest candle and Ether on the downside of 2023. So that would be a perfect opportunity to protect your Ether. And if the market doesn't change around in the next few months, that might continue to happen. So I'm looking forward to seeing how people utilize Bumper potentially to protect their Ether in that situation. I would love to know where sort of the main Bumper community is, and just how people can also get started and try to use Bumper.
Yeah, so on Twitter, or X, shall I say, it's at Bumper Finance. Same for Telegram, Bumper Finance. You'll find us there. We're in Discord as well. That's where kind of a lot of really good conversation and where you can really learn about. We tried focusing on Discord a bit. In terms of the website, there's bumper.fi. So bumper.fi is a really good starting point. You'll get a lot of information, and there are links to Gitbook documentation where you can see stuff. You can read the light paper, flash paper, all the different papers. The simulation report is really a good read, especially if you kind of err on the nerdier side. That's worth it. But if you want to just jump straight in, just go to app.bumper.fi. And have a little play.
Amazing. Thank you so much, Gareth, for your insights into this, for helping grow DeFi. I'm going to leave those community links and the Bumper.fi links and app in the description box below. All the best with everything moving forward from the launch day. Congratulations, and let's definitely follow up in the near future.
Thanks, Ashton. Appreciate having me again. Cheers, mate.